Fed is meeting September 17th and 18th. And that just usually affects short-term rates, right? Car loans, credit card debt, things like that, but won't affect mortgage rates, correct? Not so fast. More after this. Hey, Brian Thompson here, once again coming to you typically about anything Phoenix. I'd like to also keep you updated on what's going on with the market. So hit the subscribe button, ring the bell anytime you want me to come to you with some of my videos. Also follow me on Instagram, Facebook on there as well. So yeah, again, Fed meeting September 17th, 18th. They have pretty much guaranteed that there's going to be a reduction in rate. 25 basis points, 50 basis points, we don't know yet. They meet 8 times a year, and this will be the 6th time. So looking for some reduction in the Fed rate, but doesn't necessarily mean mortgage rates. The two don't go hand in hand. A lot of people get that mixed up, but it does show you a little bit of what's going on in the economy. So, and that will drive mortgage rates. So it is, mortgage rates do get affected. One of the other things is that means inflation is cooling. And that means jobs are also slowing down. So here's what Mark Zandi, the chief economist at Moody's Analytics, said. The Fed's ready to cut, just as long as we don't get an inflation surprise between now and September, which we won't, which means now and actually when they're meeting, which is just in a couple weeks from when this video is going out. So why a federal fund rate cut matters. So the Fed does not single-handedly affect mortgage rates. Okay, so that's going to be part of it. It's also going to be the economy, and it's also going to be our geopolitical uncertainty. So it's just going to show you just a broad picture of what's going on in the economy when they do cut rates. So it may not immediately affect mortgage rates, but it may help our gradual decline that we're already having. It may help that decline continue on. So what we're looking for is that gradual decline that we've seen in the last few months to continue on, and hopefully get rates down to where we would more like them. They're not going to be down to where they were, but to where we would like them, and be able to make a move and be comfortable with it. Either a move as a seller and go on to something else, or as a buyer and go into a home. So as Mike Frantantoni, the chief economist at the Mortgage Bankers Association, points out, once the Fed kicks off a rate cutting cycle, we do expect that mortgage rates will move somewhat lower. So that's good news because we want that continue on, right? And it's going to show some confidence in the market. As pointed out here by Lawrence Yun, the chief economist of the National Association of Realtors, generally, the rate cutting cycle is not a one and done. 6 to 8 rounds of rate cuts all through 2025 look likely. So that's great news. So what is the projected impact on mortgage rates? So experts, there's going to be 4 of them here who are pretty reliable, are predicting a decline in rates in 2025. And the Fed reduction in rate is definitely going to contribute to that. Remember, whenever we have an election, November gets affected, but by the time January comes around, there's no effect on the election whatsoever. It doesn't matter what political party gets elected in here. But look at this chart here. So it's saying that we're going to have a reduction. This is Fannie Mae, MBA, which is a Mortgage Bankers Association, National Association of Realtors, and Wells Fargo all predict a reduction in rates, and you can see by the dotted line here. So some are predicting more aggressive than others. The NAR is the least aggressive, and then we look at the MBA, and then the Fannie Mae forecast, and then last is the Wells Fargo forecast. So with the recent numbers that we have in the job market, it looks like Wells Fargo is getting a little bit more aggressive on the reduction, but all of these items are leading to good news when it comes to buyers getting into a home, sellers being comfortable with selling their home and getting into a new home. So going into a little bit more, what does that mean? So here's 2 things. 1, it helps alleviate the lock-in effect. What that is sellers who have a home right now, 2.75, 3%, whatever they have, afraid to go ahead and sell their home and go into another home. Here in this Phoenix market, we've got so much appreciation in our homes. It shouldn't be something we should really be afraid of. Instead of looking at the rates, we should look at the payment because of the equity that we have. But this is going to help alleviate that because we're going to start getting down into the fives. Is it 2.75? No. Is it 3%? No. I get that. But you're going to be able to put more money down. If you were in an FHA, you can potentially go conventional and get rid of your MI. So there's a lot of different options. Is it going to be best for every seller out there? No. I mean, there's going to be some situations where people are comfortable where they're at, comfortable with the payment, and really are afraid to go ahead and make that jump. I don't blame them. But it's going to be really good for some of our move down buyers and maybe some of our move up buyers as well, with having that equity and being able to put it down on a new home. Number two is it's going to boost our buyer activity. What does that mean? Well, it's a whole supply versus demand, right? So your demand is going to go up. Your supply is going to still stay down because we've been down supply-wise for quite some time in the Phoenix market. We're getting fairly close to level, but still, once that buyer activity goes up, it's, if you can get in there at the beginning of it as a buyer, that's going to be good because there's not going to be as much competition, but it's definitely going to ramp up some competition here in the valley for sure. So demand going up, supply staying put. Supply always lags behind the demand because once people start to see mortgage rates come down, some of their payments come down because the Fed rate does drop down our interest rates and some of your credit card debt as well. So they're going to start seeing they're a little more capable of qualifying for some more homes. So what should you do right now? Well, if you are a buyer and looking to potentially move into a home, get a hold of your loan officer, run through some potentials, even if they haven't gone there. And if you say, just show me what a payment's going to look like at 6% on a $500,000 home, at 5.5%, just so you know, have an interest rate in mind that when it gets there, you're ready to pull the trigger. All right, have a payment more in mind than it is the interest rate and what can possibly be done by the loan officer to go ahead and get you down there. So it is going to hopefully continue that gradual decline that we're having. Housing market is going to pick up. And according to Jacob Chanel, from the senior economist at Lending Tree, he sums it up pretty well, saying, timing the market is basically impossible. If you're always waiting for perfect market conditions, you're going to be waiting forever. Buy now only if it's a good idea for you. So the bottom line is rate reduction is coming, okay? Is it going to be 25 basis points, 50 basis points? We don't know. They're going to meet again by the end of the year. What's going to happen? Probably another reduction. Through 2025, we're going to have reductions. So just have a plan ahead. Best thing to do is get a hold of your real estate agent, your loan officer, find out what that plan is and be ready for it. So any questions, please reach out. Always here to help, but reach out to a mortgage and real estate professional to find out what more is going on with the market. So stay tuned for more. Thanks.